Imagine achieving the ultimate milestone of personal financial responsibility. You finally master the discipline of saving money. Every single month, you meticulously redirect a portion of your hard-earned capital away from impulsive spending and into your standard bank account. $100 this week, $200 the next. You naturally experience a profound sense of pride, security, and financial maturity. But then, a quiet realization hits you on a random afternoon when you log into your banking portal. You stare at a clean $10,000 balance sitting in that savings account, only to discover that the institution is rewarding your years of discipline with a pathetic 0.5% interest rate. This means that after 12 full months of sacrificing your lifestyle, your bank paid you a grand total of $50. Meanwhile, your entire digital feed is dominated by conversations regarding index funds, capital markets, and the near magical mechanics of compound growth. Suddenly, an uncomfortable low-grade anxiety sets in, forcing you to ask a critical question. Are you doing this completely wrong? The brutal truth that mainstream financial institutions intentionally hide from the public is that while saving money is an absolute necessity for survival, saving capital in isolation is mathematically incapable of building real, sustainable wealth. This exact friction point is where millions of ambitious, disciplined individuals become permanently paralyzed. They recognize the fundamental importance of accumulating capital, but they possess zero structural knowledge on how to seamlessly transition those liquid funds into growth-generating assets without risking their foundational security to break. Out of this paralysis, we must establish a principle that sounds deeply controversial to a risk-averse mindset. Where all active saving money will almost never make you wealthy. Saving capital is an essential operational stage, but it is never the destination. It is merely the baseline infrastructure, because saving and investing are engineered to perform to entirely conflicting functions. A savings account is designed to protect your capital from market volatility, while an investment vehicle is specifically engineered to aggressively expand your capital over time. Those are two completely distinct economic objectives. Let's analyze the raw, its mathematical contrast, to illustrate exactly why cash hoards act as a silent drag on your net worth. Imagine you leave the $10,000 cash reserve parked inside a conventional retail savings account, yielding a standard 1% interest rate. After one full year of inflation eroding the purchasing power of your currency, the bank hands you a nominal $100, bringing your balance to $10,100 now. Let's pivot and compare that static output against the historical performance of the broader asset markets. Looking back across the historical timeline of the past century, navigating through every single economic depression, global conflict, and corporate correction, the S&P 500 index has delivered an average annual compounding return of approximately 10%. If that exact same $10,000 principal had been routed into a broad market equity structure, capturing that baseline 10% metric, your capital wouldn't have merely sat there surviving. It would have actively expanded, shifting the trajectory of your entire financial future. The core issue isn't a lack of discipline. It's a structural misallocation of force. You are currently asking your defensive shield to win the economic war. That is a tactical error that ensures your capital remains completely stagnant. That immediate $1,000 difference in your first year might not seem monumental on paper, but it conceals a massive macroeconomic truth that most everyday savers fail to grasp. The genuine, unshakable power of the asset market isn't linear. It is entirely driven by the quiet magic of compound growth over long horizons. Let's project those exact same choices across a 20-year timeline. If you leave your capital languishing in a standard retail bank account, yielding a baseline 1%, your $10,000 principal crawls to a mere $12,200. Conversely, if you route that exact same starting capital into a diversified market index, compounding at a historical 10%, your portfolio expands to a massive $67,000. You began with the identical sum of money, yet you achieved a completely non-linear lifestyle outcome. This proves that the most devastating wealth divide in modern society doesn't actually exist between the high earners and the reckless spenders. It exists entirely between the passive savers and the aggressive investors. Yet, despite the undeniable clarity of the mathematics, the vast majority of professionals never make the leap. The barrier preventing them from scaling their net worth isn't structural intelligence, it is pure behavioral psychology. Accumulating cash feels inherently safe, while navigating the liquid markets feels dangerously speculative. When your hard-earned capital sits inside a conventional savings account, your brain receives a constant dopamine loop of security. The numbers are perfectly static, completely immune to sudden 5% corrections on a random Tuesday afternoon. But true investment assets breathe. They move dynamically up and down in alignment with global economic cycles. That structural volatility triggers immediate loss aversion inside the human brain, scaring disciplined savers away from the single most powerful wealth generator in human history. If you are currently telling yourself, I understand the math, but I absolutely cannot afford to lose my hard-earned capital, that is a completely rational psychological response. That precise fear is exactly why transitioning away from a cash-hoarding mindset must be executed in strategic, insulated operational phases rather than a singular, reckless move. Consider Phase 1, the armor of the defensive capital reserve. Before you root a single dollar into a liquid asset class, you must establish an ironclad emergency reserve containing 3 to 6 months of actual living expenses stored completely in cash. This capital must be held inside a high-yield savings account, completely separated from your daily checking account. This cash does not exist to chase speculative opportunities. It does not exist to fund lifestyle upgrades, and it must never be risked in the market. Its sole operational objective is to absorb catastrophic real-world friction, sudden job losses, medical emergencies, or unexpected asset repairs. The single biggest reason novice investors panic sell their assets during a routine market downturn is because they lacked an upfront cash cushion, forcing them to liquidate their long-term portfolio to pay for short-term survival. An explicit emergency reserve acts as a psychological shield, protecting your compounding investments from the volatility of your own life. Consider Phase 2, structural capital segmentation. You must completely decouple your capital allocation inside your head by constructing 2 entirely distinct behavioral buckets. Bucket number 1 is your safety reserves. Static, unshakable cash that never moves and is dedicated entirely to absolute preservation. Bucket number 2 is your growth engine capital that is legally permitted to fluctuate dynamically because it's explicit. Long-term mandate is to outpace inflation and generate true compounding wealth. This clean operational separation instantly de-escalates financial anxiety. It's enabling your brain to tolerate short-term market corrections because it knows your foundational security is completely untouched. Consider Phase 3, macro-habit mobilization. A pervasive myth among beginners is that entering the capital markets requires thousands of dollars in upfront liquidity. It doesn't. Modern brokerage infrastructure allows you to establish automated positions with as little as $50 or $100. In the initial phase of your investment journey, the raw size of your profits is completely irrelevant. Your singular objective is the aggressive optimization of the habit. Behavioral data consistently proves that the automated discipline of investing consistently matters infinitely more than attempting to perfectly time the market cycles. Consider Phase 4, systematic simplicity over speculation. The most common tactical error retail savers make when trying to invest is jumping directly into highly toxic, hyper-complex trading strategies. Trading volatile equities, speculating on digital currencies, or gambling on complex options contracts. In reality, the most boring, simple, and unglamorous investment vehicles consistently outperform complex trading desks over long horizons. This is why legendary wealth builders universally recommend low-cost, broad market index funds. Instead of burning cognitive energy trying to predict which individual corporation will win or lose, an index fund allows you to own a fractional slice of hundreds of the most profitable enterprises on Earth simultaneously. Capture built-in diversification, massively reduced individual counterparty risk, and steady structural long-term expansion. It is beautifully simple, and it works flawlessly. Let's run the numbers on how a completely unglamorous, highly consistent strategy behaves over a standard working career. If you automate a baseline contribution of $300 every single month into a broad market equity index averaging a conservative 8% annual return, your balance scales to a massive $285,000 after 25 years. Stare closely at the internal architecture of that wealth. Your total out-of-pocket cash contributions across those decades amounted to only $90,000. The remaining $195,000 was completely generated by pure market expansion. That is the exact compounding force you permanently deny yourself when you choose to leave your capital locked in a traditional bank vault. Asterisk to visualize this clearly. Storing your cash in a conventional savings account is the exact equivalent of locking your agricultural seeds inside a glass jar. They are perfectly safe, beautifully preserved, and completely sterile. Nothing can harm them, but absolutely nothing can grow. Conversely, transitioning into investing is the exact operational equivalent of planting those seeds deep into rich soil. In the opening phase, the landscape looks messy, erratic, and completely quiet. You will not see visible validation or massive returns overnight. But as the seasons compound, the roots lock in, the structure expands, and you ultimately command a massive, self-sustaining financial ecosystem that towers over the original seeds you started with. If you're worried about what happens to your capital, if the global markets experience a sudden, terrifying crash right after you start, you need to reframe how market cycles actually function. Corrections and crashes are completely normal. Systemic health indicators that have occurred dozens of times throughout financial history. For a disciplined, long-term investor, a significant market downturn is not a catastrophic crisis. It is an aggressive wealth catalyst. When asset prices drop, your automated monthly contributions act as a powerful value collector, purchasing significantly more corporate shares at steep discounts. When the macroeconomic cycle inevitably reverses and the market recovers, those heavily discounted shares act as a massive supercharger for your compounding returns. This is precisely why experienced wealth builders remain absolutely calm during periods of intense market red. They are calculating their moves in decades, not trading days. To scale your path to true liquid freedom, execute the blueprints seamlessly. First, fortify your household with an ironclad 3 to 6 month cash emergency reserve. Second, separate your capital mentally into dedicated safety and growth buckets. Third, activate the habit by routing small, automated amounts into the system every month. Fourth, ignore the speculative noise and anchor your capital in simple low-cost index funds. And fifth, protect your timeline from your own emotions by letting compound interest execute its job undisturbed. Traditional savings will successfully grant you short-term stability, but systematic investing is the only vehicle on earth that can grant you permanent personal freedom. The moment you choose to bridge the gap between the two is the exact moment your money stops resting and starts working aggressively for your future.